wish to take you into the panel discussion sections of this evening. And it is my pleasure to introduce to you the panelists for the first panel discussion on investment opportunities in India's public markets. Our first panelist is Mr. Sanjay Dutt, Managing Director and Chief Executive Officer of Tata Realty and Infrastructure Limited. He is managing 53 projects measuring over 70 million square feet, besides 3 ropeways, 4 roadways, and a metro project spread across 15 cities in India, Sri Lanka, and Maldives. Sanjay has over 26 years of experience in the real estate sector. He has successfully led the growth of real estate development and asset management business spread across 5 cities in India, with over 13 million square feet of predominantly IT SEZ parks, 3 million square feet of redevelopment and leasing strategies, 6 million square feet potential through 73 new acquisitions. A postgraduate in marketing and HR from the International Management Institute, Sanjay is the chairman of the Royal Institution of Chartered Surveyors, RICS India, and joint chairman of the FICCI Real Estate Committee, among the positions he holds at several other advisory boards in the sector. Welcome, Sanjay. We're happy to have you with us. Our next panelist is Mr. P.R. Somasundaram, or Som as he is better known. Som joined the World Gold Council in January 2013 as Managing Director, India. Based in Mumbai, Som is responsible for leading the World Gold Council's activities across the Indian market. Som has over 27 years experience across diverse industries, including FMCG and banking. Prior to joining the World Gold Council, Som was the Chief Executive Officer of a regional private bank. Prior to that, he was with Standard Chartered Bank and with Hindustan Unilever Limited in a variety of roles in financial management, logistics, and M&A. He's a qualified chartered accountant. Welcome, Som. Thank you for being with us. Our third panelist for this evening is Mr. Amit Ganatra, a senior fund manager, Equities at HDFC Mutual Fund, one of India's leading funds. HDFC Mutual Fund's assets under management are in excess of 400,000 crores as on December 31st, 2020. Amit has over 17 years of experience in equity research, which includes around 10 years of research in fund management. He is a manager for 5 equity schemes and 1 hybrid scheme, with total assets of around 13,000 crores. A chartered accountant, a CFA, and an MCom. Prior to joining HDFC AMC, Amit worked at Invesco Asset Management. Thank you for being with us, Amit. And to take you into the panel discussion with some probing questions and a lively discussion with our panelists, I hand you over to our moderator, A. Pramod Kumar, Managing Partner at IIFL Wealth and a member of the board at United Way Chennai. Over to you, Pramod.
Thank you, Meenakshi. Good evening, everyone. My name is Pramod. We could not have had a better summation of the economic and the business environment opportunities that the post-pandemic environment and the budget have presented, while also highlighting the challenges in implementation. He also highlighted the long-term importance in carrying along all stakeholders to avoid creating further inequalities. From an economic overview, we now switch to discussing about investment markets. The first panel is a discussion on public markets. In this panel, we hope to share the expert opinion on 3 asset classes that Indian investors hold the most as part of their wealth: gold, real estate, and equity. Gold and real estate have traditionally been India's favorite asset classes. Equities, and if you look at the Nifty and the Sensex right now, seems to be the new favorite. To share their perspective, we have with us today 3 eminently qualified speakers, each representing India's preferred asset class. We will discuss with them the factors driving the respective asset classes and the outlook from an investor's perspective. So without further ado, I'm getting into the discussion. And to start with, let me put up a question to Mr. Sanjay Dutt on real estate. Mr. Dutt, after a good run, till about 2013, real estate has kind of had a tepid period. Returns both for end users and investors have been kind of muted. industry has had its own challenges. Would love to get your perspective on the current environment, the factors in play, and how do you see the next couple of years playing now?
Thank you very much. Real estate had a very good run until between 2003 to 2008. And then we had a correction after global financial crisis. And then you mentioned subsequent to 2013, it did not see the light that we were used to. And this was predominantly because in the residential segment of the real estate, we had a lot of speculation by the developers, by the investors, by the retail investors. So therefore, there was an excessive inventory of close to about 40 months, which remained unsold. This led to a lot of challenges for developers who were borrowing very expensive debt to service their loans. They moved from banks to NBFCs, which was obviously very expensive, and they could not come out of the cycle they thought they would be able to because there was just too much excessive inventory. For the first time, that actually coincided with many other factors. And the factors were statutory changes, largely a result of speculation and consumer noises. So Real Estate Regulation Act got introduced, which disrupted in many ways, not to mention the economic slowdown that we witnessed. And then, of course, the lack of capital or liquidity problems that we faced during NBFC crisis. As a result, it led to a significant consolidation, which was never witnessed before. We saw meltdown, but we never saw developers going belly up. But this can be largely restricted and attributed to residential segment. When you look at other segments of real estate, the office market, not too many people know, in 2019 broke all records in India or perhaps globally. We did 49 million square feet of net absorption across 8 cities in India. And this was predominantly because of strong fundamentals, the cost arbitrage, the talented pool workforce, the maturity of the IT sector, which we have seen over 20 years, and the traction largely because of the services sector, even though the banking financial services remain largely affected. Many of the corporations from US continue to outsource. There are several organizations who have more than 50% of the global workforce in India. And that's really commendable. And we see that trend continue. Simultaneously, we saw GST come in. It disrupted, but also provided an opportunity of borderless warehousing logistics. So it saw a surge. Likewise, we saw hospitality and retail grow. But somewhere along this, there was also a lot of exposure to debt, which kind of created problems for the developers. So you are right. For a long period, we saw a kind of slowdown, and the pandemic added to these problems. And therefore, we see a further consolidation. The results were so serious, the government had to set up Swami Distress Real Estate Fund to provide last mile liquidity to developers to complete their projects. The last estimate there was more than 2.5 lakh crore worth of projects were stuck before pandemic. And I think now, through this pandemic journey of almost a year, I wouldn't be surprised if there are 3 to 3.5 lakh crore worth of projects. It opens up opportunities. We saw simultaneously office continue to attract capital. Close to $3 billion got invested in last 10 months. The REIT, the third REIT, has hit the market. All 3 REITs are expected to do well. In fact, the first 2 did extremely well. And we see close to 4 to 5 billion US dollar chasing real estate investment opportunities in India. And in the last 2 REITs, we saw the retail participation from retail investors. So in a way, we are finally able to attract stable 6 to 7% dividend yields for our retail investors. So real estate is turning the corner. And I believe this is the most opportune time for investors to look at as one of the asset classes for investments.
Thank you, Sanjay. Moving on to Mr. Somasundaram. Mr. Somasundaram, gold has been a very profitable investment option for the last few years. In the recent past, of course, we've seen some amount of moderation in prices. In fact, gold probably can be described as the truest global asset class and the longest serving currency in the world. How do you see gold as an asset class in a period of extremely accommodative monetary policy and high fiscal deficit, and also the emergence of digital currencies?
Yeah, good questions actually. In fact, the reasons you mentioned are going to be in favor of gold. The enormous liquidity and the stock valuations certainly have had their advantages for certain investors, but they also increase the risk of any portfolios. And therefore, discerning investors clearly look at making sure that those risks are diversified, they are hedged, and gold happens to be a good asset class to hedge that. Last year, if you really look at it, even despite all the digital and all those discussions, 49 billion worth of gold was the inflows into the ETFs in Europe and US. Of course, even the Asian ETFs did see a growth. India itself saw the ETF double, although the base is small, India and China. So investors therefore definitely have seen that gold is performing the role it is intended to perform in such situations, which is it may not give a coupon, but what it does is it de-risks your portfolio. And we have also seen over through econometric analysis, any portfolio with gold has better, gives you a better return longer term and also has less volatility. And speaking of the current situation, the biggest thing that one has to worry about is volatility. Therefore, gold will perform certainly very well in the coming months.
Thank you, Mr. Somasundaram. I'll come back to you with some follow-up questions. But Amit, equities have had a great year, right? We've been operating in extremes. Returns from March low, it's not uncommon to see 70% plus returns. How would you contextualize the kind of mood change and the optimism that's being currently seen?
Yeah, good evening, Pramod. Good evening to all the participants. So I was there, for the same event last year, and I was one of the panel speakers where, I was discussing equity. Now, see, that time, the same question was asked that what is the view that I have? And the view at that point of time was that I was cautiously optimistic. And today also I'm cautiously optimistic. However, the reasons for caution as well as optimism has actually changed in last 1 year. Last year, I was optimistic on valuations. So March, the valuations were actually quite attractive. I mean, if you compare the valuations to past for many companies, I generally, tend to look at the breadth of valuations rather than looking at the aggregate. And almost, 100 companies out of BSE 200. I generally use BSE 200 because it represents, blue chip companies in India. Almost 100 companies at that point of time were trading at very, very attractive valuations. That was in March last year. And it was actually at the same time when this event happened. However, we had come out of a very tough, economic cycle. Actually, not many people know, but India actually had a slowdown pre-COVID. So COVID actually, completely shut the economy down, but we had a poor year even pre-COVID. So FY 20 for us was like on Nifty companies, there was 1%, top line decline and 8% EBITDA decline. So the profitability cycle or the corporate profitability was actually quite weak. And obviously I did not knew that, we'll get hit by COVID, but what we knew was that the budget was thought as a kind of a balanced kind of a budget. People said that, it's a practical budget, it's a balanced budget. Some people said that maybe we could have done more for growth. We all wanted response from RBI. We wanted response from government. We wanted corporates also to respond because, profitability cycle was actually quite weak. But, one thing COVID did, And I would say that, when history is written later on, maybe, COVID will be known more as as an event which actually brought a reaction. And it brought reaction across the board. And I think as far as corporates are concerned, the biggest reaction that we got was that, they cut costs very aggressively and they focused on cash flows. So many corporates, paid debt, they focused on cash flows, their operating cash flows were higher. So now today we are in a situation where this year the top line will degrow by 9%. Now 3-quarter numbers are already out, and more or less, we have pretty much a handle of what is the likely earnings outcome this year. So we are in a situation where top line will degrow by 10%, but the PBT will actually grow by 12%. Now that's a huge change. I mean, in terms of, the corporate profitability cycle, and that is very, very important to understand. See, a lot of people, give importance to global liquidity glut. I agree that there is huge liquidity glut globally. But what many people don't realize is that, see, when COVID started, the expectation was that because the economy is not going to be operational for almost one full quarter, and there will be an impact even after that, there was an expectation that the profitability will decline by 30%. That is the expectation with which we started. Now, instead of that, we are ending up with a 10% kind of a earnings growth this year. And effectively, this year, our top line will actually be 10% lower than FY19. But our EBITDA will be 1% higher than FY19. So, in that sense, the economy is down 2 years in terms of top line, or corporate profitability is down 2 years in terms of top line, but the profitability is actually intact. It's higher. So I think the biggest change that, COVID has brought about is the reaction. Reaction came from corporates. It came from RBI. It came from, government of India. There was a global reaction also. We should remember that, a lot of liquidity was pumped in globally. So all this reaction has meant that corporate profitability cycle has turned. And that explains, a lot of this market euphoria. I mean, see, last year, and that time March happened to be very unique. See, generally for any investor, if they want to make returns in equity, I always tell them that 3 things are important. One is your entry valuations. The second is the trend strength of the earning cycle during the period of investment. And third is the exit multiples that you are likely to get. Now, obviously, we don't know what the exit multiples, are, because that we only come to know by the time we exit. But what we clearly know is the entry multiples, and we experience the earnings.
Right.
Now, last March, the earnings were not in your favor. You actually had a weak earning cycle. That was the past. But you had an attractive entry multiple. Now, today, the earning cycle is finally in your favor as an investor. But unfortunately, the valuations are no longer in your favor the way they were in March. So once again, you are back to, cautiously optimistic.
That's a very good summation also, and it gives a clear direction on corporate profitability and what you think about it. Mr. Dutt, if I may ask you, the emergence of RERA, one of the challenges, there was a perception at least that investors, both investors and end users, were always a little skeptical about the whole industry. But how has the emergence of RERA made a difference to long-term investment returns, for investors who are looking to invest? You obviously said this is a good time to look at investing in real estate. Just getting like SEBI getting formed in 1992, is it RERA forming a similar movement?
It is true. And I think the RERA sent a very strong signal across the developer investor community that you need to honor and respect the contract that you sign with the customer. What obviously happened in Noida and many other parts of the country, including Mumbai, there was a lot of speculation and developers were not able to honor their commitment, which really led to a lot of suffering. So I think that the way the courts dealt with such matters, the way Maharashtra and Haryana RERA, which are the strongest RERA right now in the country, and other states are very quickly catching up, have announced their decisions and penalize the ones who have not lived up to their commitment. By the way, simultaneously to the customers who have failed in their commitments to the developer, have set some very high benchmarks in terms of compliance and adherence to law. And I think that has been a game changer, and one of the reasons why there is finally a consolidation happening in the real estate. However, at the same time, there are many states which are still not able to cope or create the infrastructure and therefore provide the much needed relief that RERA is supposed to provide to real estate. So I'm only hoping that the pressure from the customer and the discipline that the businesses demand will create that impact. But overall, it has been very, very positive. I would say it has also made the real estate sector far more transparent, because you now can have access to all the projects on the government website with all their commitments made black and white, with sanctioned approval plans, etc., etc. So kind of a depository of knowledge and information, which helps institutional investors, retail investors, the analysts to have access and help their respective clients take an informed decision. So really, it has played on very well.
Thank you. Mr. Somasundaram, let me pack two questions together. What is the trend you're seeing as far as the investor preference to get into gold? ETFs have emerged as a big vehicle. Is it still physical gold? The sovereign gold bond funds have been a big hit. And a related question is if, because so much of money is going into ETFs also, not only in India and global, is it making the whole asset class a little more speculative, or do you think it is a counterbalancing force?
Well, in terms of preference, we see ETFs have obviously had the biggest inflows, but that was not the only thing. It's a very strange thing, particularly in Q4. What we saw was that investors across the markets, and you'll be surprised by that, went for bars and coins. Jewelry, of course, was down because of logistics reasons and artisans going away in most of the markets like India, China, all that kind of stuff. Bars and coins were absolutely lapped up by every market. And surprisingly, you'll see even Germany last year became the second biggest market for bars and coins. It normally used to be China, followed by India. India actually got relegated to the third position. Obviously, logistics reasons, a price 50,000 is not easy to shell out. Germany actually bought 163 tons from 89 tons in the previous year. So, and you saw the same trend. Turkey, massive jump in bars and coins. So it is not just ETFs. It is generally to do with an explicit investment purpose. Turkey is also a jewelry market. So explicit investment purpose was seen in the investments in gold. Now, to answer the question, are these speculative? You see, when some of the ETF flows could be driven by liquidity, but if you really look at the size of the flows that we saw, and even amidst the volatility, there were outflows as well. It is not that it was always one way, because then the risk is higher. We saw outflows in November, December. You put all that together, you see this is not short-term money that's flowing in. It's quite people who otherwise probably, even in India, I would say, could not afford a jewelry, because jewelry you have a labor charge which is higher, probably went into ETFs to actually protect their gold. So I would not say that ETFs or anything leads to a speculative thing. This is not definitely speculation.
Thank you. Amit, you obviously are confident on corporate earnings, but one of the features of our markets or even global markets is that, it's been fairly polarized. In India, largely for the last 5-6 years, it's been the defensives, companies with high ROE and ROCs, FMCG, paints, ID, pharma, private sector, banks. You could always say the top 15 stocks of the Nifty would do well. Are we now going with corporate growth coming back in and, effectively the government trying to spend its way to growth? Are you expecting leadership change? Are you expecting, a rally becoming more broad-based?
Yeah, good question. See, that change that you're talking about, actually many people have not realized, but that has already happened. So once again, I'll give you some data points. Uh, now, there was this period pre-COVID. Then there was this COVID period, which was a 3-month period for markets. And then there is this post-COVID period. The post-COVID period, basically, I would say started from April onwards, because that is when the recovery in earnings, people started seeing earnings upgrade. So now there has been almost 3 quarters on a back-to-back where we have seen, corporate profitability actually doing better than what one would have anticipated. Uh, the 1 year prior to COVID, uh, you once again look at BSE 200 and you just sort them based on price to book, which is, asset-based valuation. That's the best way to value in a time when, earnings cycle one is not clear. Uh, so if you just sort them based on price to book, the top 50 or the most expensive 50 companies, they were hugely outperforming the cheapest 50 ones just 1 year prior to COVID. And that is where, the quality or, growth or whichever way you frame it, but those kind of companies, did extremely well. Even during COVID, when, markets were going down, once again, the top 50 companies were used, once again outperformed the bottom 50 ones. So they did better than the cheaper ones 1 year prior to COVID. That was a period of economic slowdown. We should remember that. And then even during COVID, when the expectation was that, economy will, we don't know the bottom at that point of time. Obviously, we did not know what the bottom for the economy would be. The most expensive 50 companies, they did much better than the cheapest 50. Then, when post April, from where the economic recovery has, started to happen, the cheapest 50 have now started outperforming the most expensive 50. And that too by a decent margin. And that is happening every month now. So it is not that, it was a 2-3 month phenomenon. Continuously, we are seeing the cheapest 50 companies are now starting to beat the expensive 50. And that is not, just by fluke. It is because there is a corporate earning upswing that is visible in many of these companies, which was not the case earlier. Because see, now whether it is a cheap company or whether it's an expensive company, everybody has looked inwards. Everybody is trying to, focus on cost. And most of the companies, whether it is expensive or cheap, we have to remember that they are part of the organized space. And in COVID, one thing that happened was that there was huge consolidation across the industries. So companies benefited in terms of top line. Their top line, outcome were better than what overall India's outcome were. And they focused on cost. So that's the reason that, profitability surprise was superior there. And valuations, the starting valuations were cheaper. See, this is typical of a, classical recovery. Whenever there is a recovery, there is bound to be mean reversion. Whenever there is, economic down cycle, there is bound to be divergence. Okay. What we saw prior to COVID was divergence. What we are seeing post-COVID is mean reversion.
Okay. That's very well put, Amit. So, we could go on discussing many points. I have a list of questions for all of you, but, just for the lack of time, would I request all our panelists to give us a view from an investor's perspective. What would be the outlook or what would be the key factors that you would ask the investors to look out for and your own positive view? Mr. Dutt, if I could start with you.
Thank you. I believe after work from home culture, the significance of residential as a segment has gone up substantially. The office market continues to be robust. Who would have thought that during pandemic, 4% occupancy, 100% payment of rent, and 25 million square feet of commitment of office space, even when you're not attending the office fully, will get committed as in 2020. So I believe the is likely to remain. There would be some cautions and corrections in some cases, but it's likely to go up by the customers, but also by the lending institutes who are now even more cautious who to capital. So I believe what has really emerged as as an investor, who to invest with and in which markets to bet on, and you are entering the market at all-time low.
Mr. Somasundaram?
As I said, gold is just performing its role, and this is not a time to actually, this is a time to understand risks and be diversified. Like all asset classes are doing well now. I mean, gold is doing well and equity markets are doing well. We have always heard that, they are inversely correlated. But that inverse correlation definitely works when there is, the equity markets don't do well, not so much when it's going up. So it's important to make sure that you have gold in your portfolio so that your ability to take risks with other asset classes is higher. So that is what I would tell them, and not be driven by just 1,000 rupees, 50,000. There's so much liquidity. The entire monetary stimulus seems to be an experiment across all the economies. It's a time to actually go for tested asset classes and not just those, and diversify.
Yes. Thank you, sir. Amit?
Yeah, so I think three things that I would generally advise at these times. One is that don't ignore equities because corporate earning cycle is in your favor. That is something that we have been waiting for a long time. So I think one should not ignore equities at this stage, but one should respect asset allocation. Cannot just be gung-ho about one asset class. I agree with the other panelists that, gold is a good addition to the portfolio because it ultimately, ends up hedging the risks. And third is that, if you were looking to buy a house, then I think this is the best time to buy. Not only, prices are in your favor, but interest rates are also, in your favor. So I think those are the three things that I would suggest.
Thank you, Amit. You kind of did the summation for me, but very useful insights. Basically, real estate is it's consolidated, it's getting regulated, it's ready for a turnaround. Gold continues to play its part as a risk diversifier, and equities, the corporate earnings cycles turn. That's a great insight that all investors can use in building their portfolios. I'd like to thank our panelists for their time, their insights. I'm sure the investors will benefit from these valuable insights. So thank you, everyone. Over to you, Meenakshi.